All right, so now we're going to look at the next chapter. This is chapter 19, your materials. And chapter 19, you may have noticed from your reading, it's kind of confusing for a number of reasons. First, you have to deal with something called earnings and profits. That is not a lot of fun, I understand. Kind of a confusing topic. So this is a particular section where it's helpful to just sit back and ask yourself, what is going on? Why are we spending all this time looking at what earnings and profits are? And what's the purpose behind that? And when you understand the purpose and really grasp that concept just at a conceptual level, it's helpful when you're looking at the specific details, because you then don't get lost in the trees. You understand the forest from the trees. So earnings and profits and dividends are the main topics that we're talking about here. Really what's going on is anytime you have an asset or some degree of value flowing excuse me, from the corporation to the individual shareholder. That's what we're concerned with. Remember, in the last chapter under 351, we're all focused about assets and liabilities and etc. flowing from the shareholder to the corporation. So that was the focus. Now this is the opposite focus. Now, this chapter is titled Distributions Not in Liquidation. And distributions in liquidation are a little simpler. What you can imagine would be the case if you form a corporation and then you immediately liquidate the corporation. Maybe a month later you decided it was a bad idea. You can imagine that the idea would be that you were then getting the money back out in exchange for your stock. You're essentially liquidating the corp. The corp's no longer going to exist. You're just making it no longer be around. And if that's the case, you would imagine you should get some kind of return of capital that's non-taxable. And at a very simple conceptual level, that's what you would expect to be the case. But on the other hand, if you're receiving a distribution from the corporation and it's not in complete liquidation, so the corporation is not liquidating, in that case, you would imagine that it would be treated as a dividend. That's probably the extent of your knowledge of what a dividend is right there. And so what we're going to do is look a little bit more closely at each of these concepts where a distribution is made and it's not in liquidation in this chapter. And earnings and profits is going to play a very significant role. And the reason we care about earnings and profits is we're really just trying to decide, is this more or less a partial liquidation of the corporation? Is the distribution a return of capital? Is it just earnings from the corporation that are being distributed? Is there something else that's going on? Or are we distributing earnings? Are we distributing funds that are neither capital nor earnings? Did we just borrow a bunch of money and then distribute it to our shareholders, even though we haven't earned anything? So there are a bunch of different questions that we're going to look at in the chapter. But the idea and why we care is we want to know whether the distribution is a qualified dividend. And what does that mean? Well, qualified dividends for the shareholders affect the tax nature of that dividend. So dividends for tax purposes can be ordinary dividends and they can be qualified dividends. Let's take a look at a Form 1040 really quick. You can see lines 9 and 9A and 9B. This is where you're going to report dividends. An individual will report dividends received from a corporation. And ordinary dividends are 9A. What you'll notice is that's slotted right next to taxable interest and wages, salary, and tips. Then you look at line 9B, which is qualified dividends, and it's kind of held out over to the side. And these items that you see in the middle, not to the very far right, are items that are going to be taxed differently. You'll see capital gain and loss. It'll go in off to the right, but then it comes back out later. But ordinary dividends might not be taxed. Well, ordinary dividends, first of all, are taxed at ordinary rates, just like they sound. They're ordinary. It's just ordinary income to the taxpayer. And so the taxpayer is not going to want ordinary dividends. They're going to want qualified dividends. Qualified dividends are taxed at capital gains rates. So there's a tax preference for qualified dividends over ordinary dividends. So that's a big deal to taxpayers. They want to know how the dividend's going to be taxed, and that makes a big difference. So looking at earnings and profits is going to play a role in that, and a number of the different things we'll look at today are going to play a role in the dividends. Now, just to give you a little format for where we're going, we're probably going to just introduce Chapter 19 today. Since this is an online format where you can't do a Q&A, I decided that the next time we'll do the remainder of 19 and 20 ahead of your simulation. Because I feel like this particular format where you don't have a Q&A, it's a little bit problematic. So wonderful. So that gives us an idea for where we're going. Some of the other things that are affected, in addition to the qualified dividend versus ordinary dividend issue, is whether the distribution from the corporation to the shareholder is going to affect the basis of the shareholder's stock. You also have issue with, remember, under 351, we covered a lot of rules for giving property to a corporation. Well, now the corporation, they don't have to just give cash, they could give property out as a distribution. And so the character of the property being distributed matters. Remember, we had a lot of character of the property issues that came up when we were giving the property to the corporation. And so this is now the corporation giving property back. And then the issue is another couple other things to look at are whether the shareholder gives up ownership in return for the distribution and whether the distribution is liquidating or non-liquidating. And in this chapter, we're looking at non-liquidating distributions. Once again, why that matters? Well, if the corporation is ceasing to exist, then you can imagine the rules might be a little bit more favorable in terms of treating any amounts paid out as a return of capital. One other aspect of the big picture, and this is what we're going to focus in a little bit more on in this chapter, is the function of earnings and profits and how that affects corporate distributions. So distributions out of the corporation's earnings and profits, and I'm going to be referring to that as ENP. So ENP, distributions where the corporation has earnings and profits, are generally deemed to be a dividend to the shareholder. So we care a lot about what ENP is because that helps us know whether these funds that were distributed is deemed a dividend or not. If the corporation has no ENP, then the distribution will generally be deemed to be a return of capital, which reduces the shareholder's basis. So as long as there's no ENP but the shareholder has basis, it's just deemed to be a return of capital. Well, why do we care about that? Well, a return of capital is not taxable to the shareholder. It simply reduces his basis. So if he sells his shares later, he'll realize or recognize a larger gain instead of recognizing a dividend now. So you get deferral of taxation for the shareholder, so that's good, and it changes the nature of the gain. If the stock is ultimately not found to be worth anything, instead of getting a capital loss later, he's reduced his basis now, and there you are. So a reduction in basis is usually a good thing, as opposed to taking a dividend. On the other hand, if it were treated as a dividend, he gets dividend now, he's taxed on it now, and then if he sells a stock later for less money, then that's a capital loss, which isn't really something shareholders are looking to achieve because of the taxation treatment of capital losses. There are a lot of limitations for individuals in particular. So and similarly, there are limitations for corporations if the corporation's a shareholder. So if the distribution with no earnings and profits exceeds the shareholder's basis in the stock, then it's treated as a gain from the sale or exchange of the stock. So once again, earnings and profits is hugely important in terms of deciding the nature of the corporate distribution. But big picture, and once again, you got to think about the big picture here, because earnings and profits gets really complicated. Determining what the earnings and profits are is a very complicated calculation, but I want you to know why we're doing it. We're trying to decide if the corporation earned enough money to where the funds that are going to be paid to a shareholder as a distribution should be treated as a dividend, or whether the corporation is just returning the capital to the shareholder that the capital gave in. Really important fundamental concept. And again, the whole chapter is going to be dedicated to determining how these distributions are treated. But E&P is really complicated, and so I just want you to understand the big picture, what we're trying to accomplish. If the corporation had earnings, it would make sense that this distribution is a dividend to the shareholders. If the corporation has no earnings, then something else is probably going on. How in the world is the corporation paying a dividend, how in the world is the corporation paying a distribution to its shareholders if it hasn't earned any money, if it has no earnings and profits left over? Well, if it has no earnings and profits left over, it could just be returning, and probably is just returning, the capital that the shareholders paid into it. And so that's why it's treated this way. What if it's paying amounts in addition to the capital that was paid in? What's going on there? And it's not from earnings and profits. Well, you can imagine a situation where a corporation is newly incorporated, the shareholders put some funds into it, and then the corporation takes out a big loan. So it has cash, but it hasn't actually earned anything, and there isn't really even that much. There aren't really even very many assets in the corporation that were provided by the shareholders. Well, what if it pays that loan out to the shareholders over time? Maybe we'll say not immediately. Well, you can see, they've now had some sort of income from that, because the liability was taken on by the corporation, and then it used that liability to pay money to its shareholders. So you can see how that suddenly, the amount that they've received in excess of the amount they put in, should be treated as a gain or income of some sort. And so that's why it's treated as a gain from the sale or exchange of their stock. Ultimately, the corporation with zero, the corporation at that point has a pretty ugly balance sheet, you can imagine. And if the corporation were to dissolve, you'd be questioning, well, who gets left with the bill, and that comes up later. But the important thing to understand is conceptually the role of earnings and profits and capital contributed for shareholders in terms of deciding whatever the shareholder gets from the corporation, how that's treated. So that is our big picture for this chapter, and really for the next two chapters, frankly. But this gives you the idea of what we're looking at. Why do we care, and how to do the analysis? So anytime you see funds coming out of a corporation to a shareholder, you need to ask yourself, is there earnings and profits? Have there been earnings and profits? Is this a distribution from earnings and profits? And that's the big question. So usually problems are going to involve calculating earnings and profits to decide whether the distribution is deemed to be a dividend or a return of capital or a gain. Now, up to this point in your life, whenever somebody used the word, people didn't talk about distributions, they just talked about dividends. So if you're saying something's a dividend, by definition, you're saying it's something that was paid out of earnings and profits. So we kept it simple for you, probably in your individual tax course and even your property tax course, where funds paid out of corporations were just, we always called them a dividend. You might even think definitionally that anytime you pay money out of a corporation, it's a dividend. Well, it's not. Money paid out of a corporation is a distribution, and if it's out of earnings and profits, then it's a dividend. If it's not out of earnings and profits, it's either a return of capital or a gain. And so, once again, a little bit of complexity added here to under the tax code in terms of corporations and how these items are going to be treated, both on the corporate side and for the shareholder. We care in both directions because the corporation is a taxable entity, and these tax effects matter for the corporation as well as for the shareholder. So these are important concepts that we're kind of broadening your mind, going a little bit more in detail, and I just want you to understand the big picture, what it is we're doing. So that's why I paused. I'm taking a lot of time here at the intro to the chapter so that you know that when we're looking at AMP, what it is we're doing. Okay, so that gives us a pretty good feel for where we're going today. Another special feature of today's class is a quiz. Now, I didn't have, I did not load an actual quiz into Blackboard in terms of a quiz that you can take live. So this quiz for chapter 19, since I really think the problem method is important in learning the topics, what we're doing is a take-home quiz. And so really the quiz is just a nice little PDF file that's on Blackboard. So I want you to download the PDF file, or upload it, I guess is a better word. Upload it to your computer, print it off, get a hard copy, and then work through it. And it's going to be graded just like a regular quiz, but it's a take-home quiz. So you can use your book, everything, open book, open note, everything's fair game in terms of the quiz. Don't utilize your classmates. That's the only resource that you're not permitted to use for the quiz, but you're welcome to go through the book all you want or use any outside resources, although the book is going to be your best resource in terms of preparing for the quiz and your notes from today's class. But by and large, I would just say, work through your book for the quiz. It's a take-home quiz. It's on chapter 19 exclusively. It's going to be a little bit more challenging than the quizzes we do in class because it's take-home in nature. You can look up the answers and think through. But I think conceptually the problem method's really important, and the start of class time we're going to go through the quiz answers, and that will set us up for answering any questions you have about chapter 19, and then I'll finish my discussion of chapter 19 at that time. So that's kind of where we're going, and I hope you enjoy the quiz. I say that and then I laugh, of course, but it is a good way to learn, and it's helpful if you're looking through the materials thinking, okay, how can I solve these problems? It helps you to read the materials with a sharper eye as opposed to just passively reading through it. So I was worried this is already passive in nature. You get to sit here and listen to me talk and look at my slides. And so I wanted to have some sort of active learning environment for this particular week. And the take-home quiz just seemed like the best way to accomplish that. So good luck on the take-home quiz. Bring it to class next time. I'll be accepting it at that point. And that's pretty much it for the quiz.